Welcome back to Two Gents, 2 Cents, brought to you by 15 Minutes of Finance. This is episode 26. Is a 1% advisor fee worth it on your investments? Now, we've spent a lot of time in the last couple episodes as we get close to the end of the year here talking about how you should be reviewing your portfolio performance. You should be reviewing your account, seeing how your investments are doing. And so as you are doing these type of things and you're looking at your account and the performance, or you have an advisor and you're trying to see, are they doing a good job? A lot of people have sort of the question of, is it worth it to pay? We refer to it as an AUM fee, an assets under management fee, where the advisor is managing the assets and they're charging a percentage fee of those assets, and that's how they get paid. I've seen recently, especially online, from even potential future clients, pushback on this idea that advisors deserve an AUM fee, or that an AUM fee is worth it necessarily when working with an advisor. So this is our sort of answer to that question. The first thing I want to make very clear is our bias on this topic. We are AUM fee advisors. We manage a wealth management firm where we manage clients' assets, and depending on the complexity of their investment philosophy that they want to implement, or what they want from us and the amount of assets they have under management, we charge a percentage fee based on those assets. It averages out probably to 1% or just over 1%, depending on the client that we're working with. So that's our bias. We operate this way because we believe that it's the best way to operate. That being said, obviously we have a bias that this is a good way to do things. So you should listen to episodes from fixed fee advisors and compare their answers and make your own determination. But I see a lot of advisors that aren't transparent. And I'll give an example without calling anybody out, but I was sent a person who they said, look, I listen to a lot of this person's content. They're a CFP, they're a previous portfolio manager, and I really like all their advice. I'm learning a ton. It's all free financial advice. So I went on their channel, and 9 times out of 10, I really agreed with the content that this person produced. Almost 1 million followers on Instagram, making 3-4 videos a week on kind of 1-minute concrete financial tips. A lot of it's great. Every video begins with, hi, I'm blank. I used to be a financial advisor and now I make financial content for free so that you don't have to. Well, you'll notice something about 3 weeks ago that happened with this person's channel, as for years they've harped on you should only pay a fixed fee advisor. Your advisor should not be paid based on how much assets you have under management. Well, now here's how all their videos begin. Hi, I'm blank. I used to be a financial advisor and portfolio manager, and now I work with Facet to bring people like you good financial knowledge. Facet is a growing company where they pair you with a fixed fee advisor. So there's no free lunches in this world. If you're listening to somebody, they have an angle. That's why I want to address ours. We, of course, have an incentive to promote the idea that an advisor is worth it, but we're also the first to tell you you don't need an advisor. So do we think an advisor is worth it? Yes. I'll list my reasons why, and then I'll open it up to James and we'll have a discussion about it. That being said, do we think it's a necessity? No. Everyone has the power and should gain the financial knowledge to invest money themselves. But if someone is promoting you something that seems too good to be true and they're not addressing their financial incentive, all they're doing is building up a market to eventually commodify. Okay, so all that person was doing was bashing on fixed fee advisors because now they're at 1 million followers and they monetize their entire follower base to try to push them towards a fixed fee platform. So everyone that you listen to has an angle, and be very wary. Make sure you know what every person who you're getting knowledge from, what their angle is, so that you can understand their content with that lens and that framework in mind. Here's why I believe a financial advisor for most people makes a lot of sense under an AUM model. There's 4 reasons, and then I'm going to open up to James, who has a lot more personal experience and work experience related to this. Number 1, an advisor is wanted, not needed. We're the first person to tell you you can invest in long-term index funds, you can invest in market ETFs, you can forget your money, stop tracking it, stop stressing about it. Unless we are in World War IV and you're in a bunker, your money's going to go up and you're going to build wealth. This channel is built on one principle that we end every single episode with. Invest early, invest often. We believe that. We believe the only thing needed to grow wealth is a person to be diligent about growing wealth by investing as early as possible and consistently investing often. And if you do that and you don't make stupid, overly risky decisions, you will grow wealth, and we want to empower everybody to do that. So why do you work with an advisor? To add value. So that's the number one framework to understand. You don't go into a conversation or a relationship with an advisor thinking, I need this, and it sucks that they charge 1%. You should ask yourself the question, do they provide value to me that exceeds 1%? It's a difference in thinking, and it makes a big difference as you think about what your advisor provides for you and whether or not that relationship is worth it. Number two, it only takes marginal success to be worth it. So an advisor on average charges about 1% of an AUM fee. This is what this means. An advisor only needs to be 1% better than you to add value to your account. And we've posed this hypothetical before, but I want you to think about any field where if you go up against a professional with a little bit of listening to podcasts, you can do it exactly as good. There's not 1% difference. Look, let me tell you something. James hasn't played basketball at a competitive level for many years now, okay? We graduated in 2016. I dare any of you to watch a lot of podcasts and go to the free throw line with James and make more free throws than him, right? There's reps, there's skills, there's experience. It's the same thing with your financial advisor. Can a financial advisor, and can they promise they're going to add 5% to your account every year? Of course not. But they only have to do 1% better, because if they're doing 1% better on average per year, they're paying for themselves, because that's the value they're adding in returns to your account. And anything above that means you made more money by using them. So a lot of people focus on the cost of advisors, but the question you have to ask yourself is this: is my net return higher by working with an advisor? Are they making trades? Are they not making a panic sell? 1 or 2 times a year, that adds 2% to the account because they made a slightly more rational, informed, professional decision over your assets. If the answer is yes, it makes sense to work with an advisor. Vanguard did a study where they compared accounts where advisors working on the account using best practices for an RIA fiduciary advisor versus people self-managing their accounts. And they found on average, advisors add up to roughly 3% yearly in returns to those accounts. So I'm going to show you what that looks like. If you're 25 years old and you have $10,000 in a retirement account, and your advisor does 2% better, so even under Vanguard's estimation of what they think an advisor can provide to an account, okay? After 40 years, when you're 65 and you retire, that $10,000 at 8% is $217,000. Awesome. You're better off than your peers. You invested early, you had 40 years of returns, and your money more than 20x'd. That's awesome. At 10% rate of return, that money's $452,000. It's more than double. So I don't think a lot of people really consider that with the power of compound interest, very, very marginal increases in rate of returns because of the value that an advisor adds massively, sometimes double or triple compounds the ultimate value you have at the end of your account life. Number 3, there's shared success. This is really what it comes down to between an advisor who has a fixed fee, who financial plans or gives you advice, versus an AUM advisor actually managing your assets. The moment that check clears to the CFP, you hope they follow up. You hope they care. But if they don't financially have any stake in your success. I could have the best financial planning meeting with you in the world, but if you don't implement it, I still got my fixed fee. I don't care. Why would I care what you do with that advice financially? You paid me for the plan. The plan was good. Your follow-up with that advice could be bad. It doesn't affect that my advice was good. You want an advisor to have a financial stake. Look, there's a lot of people we work with that have significant minimum investments below what most advisors would work with. We have people with 4 or 5 figures in a Roth IRA. They were a tax client. Hey, we'll work with you. And they've had oftentimes very good returns in their account. We usually wouldn't work with someone that has, or an advisor wouldn't, with someone that has that little money in their account. But we're completely upfront with the fact that we're working with you because we think that's going to be $1 million when you retire, and we want for 30 years to do right by your account. And we have shared success because now in 30 years, when you've been putting $7,000 into that Roth IRA every year, and it's compounding every year, and it's $1.5 million when you're 65, well, now you're a $1.5 million client. If we're giving you fixed advice, we don't care how much money you have, unless some new fork in the road affects your wealth. The advice is the same. We're just going to talk to you about investments. So we don't care how well you do. An advisor that charges an AUM fee, they want your AUM to increase. They have shared success in your investments, which incentivizes them to be diligent and work hard for your money. Fourth and final reason, and this is just to address this question. Well, if I have a financial advisor, why should I pay them twice as much just because I have $2 million instead of $1 million? And that's one of the biggest pushbacks that I see with working with AUM fee advisors. This is my answer to that. As fiduciaries, we are legally bound to do what's right in the interests of our clients. So there is an element that we have discretionary authority over the entire AUM. We have to be compensated for the entire AUM because our liability applies to the entire AUM. If James makes a completely unsuitable trade and they sue and it's found that he did not act in the fiduciary responsibility, well, the lawsuit is more for someone with $2 million than $1 million. It's kind of like saying, well, you just brought me my food. Why should I tip 20%? You could have brought me a cheeseburger with the same effort that you brought me a ribeye steak. It's not how it works. It's if there's liability incurred. All of those are based on the amount of potential losses that were garnered. So yes, a $2 million account. Now, usually advisors have a scaled system where there is some recognition of that effort gap where the fee charge goes down as you add assets under management. But at a baseline level, there is a difference between someone with $2 million and $1 million. The liability is different. The fiduciary responsibility is different because the amount that we have under our discretionary authority is larger, and therefore our liability is larger. So those are my 4 reasons. If you ever have someone who's not sure if an advisor is worth it, those are all of the reasons we operate the way we do. Hopefully, I've addressed the fact that, of course, we have a bias to defend the way we do business, but it's not required that we do business that way. So the cause and effect is backwards. We don't act as fiduciary advisors and then defend the way we do things. We operated our firm as a fiduciary advisor firm because we believe it is the right way to do things, and that's why we consistently defend that way and why we think it is the best way to work with an advisor on your account. All right, now that my 4-reason rambling is done, James.
Hello, everybody.
The actual advisor here in this conversation. So as you've worked with people's accounts, as you've worked with quite a few clients over your various jobs that you've worked in now with your own practice here with me, what's the number one thing that kind of is on your mind as you talk about this conversation of, well, why should I pay my advisor 1% of what I've earned?
Yeah. The first and the most constant and biggest thing on my mind recently is advisors all operate differently, but they all, for the most part, try to get paid the same way. And it has to do with how much money, how much investable net worth somebody has. And I have a really big problem with that because a lot of the advisors don't do any of the investment picking, but yet they're getting paid off of the investments. Right. And so then it becomes a really expensive handhold with no real value from the advisor. Now the advisor, maybe they know the right fund managers or the right third-party asset manager, the right insurance product for you. So there's some broker value that they have, like buying the right products, getting you in touch with the correct people. Excuse me. But they're getting paid on your assets on an ongoing basis for a transactional it's a service technically, but it's on a transactional basis. And I have a moral conundrum with that because it's not ongoing value. It's more like a retainer. Like, oh yeah, we're available whenever your annuity comes due or your new insurance comes due. So the biggest thing for me is that advisors, most of them do a transactional service versus a ongoing advice, money management, value, constant ad.
Yeah. And so if I'm understanding you correctly, you're saying you believe in the concept of an AUM fee, but only to an advisor that is actually managing the assets, not someone who's putting your assets in a third party and now there's two people charging you based on AUM, but only one person even has responsibility.
Yeah, exactly. The best way I can sort of paint the picture is you've got an engineer A who does all his own investments. He's in low-cost Vanguard funds. And he goes and speaks to the financial advisor, and the financial advisor is like, well, we'll roll over your account. We'll charge you 1.25%. And, oh, by the way, we don't do any of the investment picking. We hire another firm to do that. All we do is connect you, but we're still going to get that 1%, 1.25% on your account. Well, the engineer is going to go like, well, why would I pay you? Yeah. I've been doing it myself. Like, I just wanted your advice on my whole picture, really. And so the financial advisors or planners more so have value in a whole picture ad because there's so many different pieces to a financial plan, but you really don't need one. Like I think if you spent 20 or 30 minutes, you could pretty much online figure out, oh, okay, this is what I should do. This is what I should do. I shouldn't do this. But people don't really want to do that, right? And so it's like changing your oil. You could change your own oil pretty easily. Or you could pay someone to do it and then you just, you can clean your hands of it. But instead of just someone doing your oil, they're actually, it's like the way, I guess this is just what popped in my head, but like they're taking your car for 3 days, changing your oil, but then using your car for Uber and getting paid. It's like they used your car for something completely different. They changed your oil, but now they're making money off of using your car for Uber. And that's what these guys do. They're taking your accounts and they're giving you advice, but now they're making money off of it, but not doing the investments. Somebody else is.
Yeah. And if I take my car to get cleaned, it's the equivalent of, well, I take you to the car cleaner and you say, well, this is how I'd clean a car, and then I pay you $50, and then you charge me another $25 to send it to a car cleaner. And it's like, well, what am I paying you for if you're not cleaning? I don't need your advice on how to clean a car. If I'm paying you 1%, you need to clean the car.
Right. That's exactly it. That's way better than my Uber analogy. But yes, that is exactly it. And I get frustrated because typically the advisors that do that kind of work, they're just salesmen and they're smiley and they're bubbly and they sound good and, oh, how were your kids? And they remember stuff about you because they took notes. And it's like, oh, these people are just schmoozing them.
Yeah.
And it's
all trained. Like, let's be honest about the look behind the curtain. I did enough, summer job Cutco sales to know the way those teams get amped up. And I mean, that's all trained. Like it's so manipulative. I mean, there's lists of things like make sure to get their spouse's name so you can mention in the follow-up meeting.
Yeah.
Like say something about the previous meeting to remind them. Like it's not real connection. It's all the stuff that makes you think you work with them. But look, guys, none of those people are more important than your retirement. All right, you don't need to be best friends with your financial advisor. So if they aren't earning value for your account, they're not worth 1%. Doesn't matter how much they ask about how your kids are doing in soccer this year. It's not worth it if they're not adding value.
And then the truth is too, like they're charging 1%, but then the things that they're putting you in or that they're working with the actual money manager at XYZ firm who's also charging 1%. There's hands in the pot everywhere, guys.
Yeah.
You guys are getting... There's so many people coming to dinner and there's actually no food left is really what it is. Mm-hmm. And it's like, oh, I thought this was just going to be like a 2 or 3 person thing. I didn't know there was going to be 25 people involved. Yeah. And there is almost always, and clients will never know that unless someone tells them.
Yeah. Yeah, those fees are so much less transparent. Like usually someone will ask and the advisor will say, well, what's the AUM fee? But there's usually very little open and upfront communication about what are the fund fees or the TAMP fees that I'm paying for, that someone else is doing my assets. We just met with a client today for a potential retirement plan, and the previous advisor had sent a proposal that puts them in American funds. Well, clients don't know this. American funds are incredibly expensive. I didn't know this. James explained this to me on the car ride over here to the office. So I didn't know that specificity of this world of investing. But James has worked in that field before. Say, oh, yeah, well, this is why he put them in American funds, because the advisor is getting a kickback, and those funds can be more than 0.5% extra you're being charged in your account, where there's Vanguard funds for less than 0.1% that basically track the same indexes.
Exact same. They do the exact same thing, but one is called American funds and one's called Vanguard. And, I mean, they can charge whatever they want, realistically. It's just that it's whatever your advisor wants, really. Like, are they really doing the best job for you? And look, I'm not trying to trash other financial advisors. I think it's lazy if you hire a financial planner and you're like, oh, they just take care of everything for me. Not really. They're just showing you things, and they're like, yeah, you should do X, Y, and Z, and then you still have to do. Like, you still have to own the product that they're giving you. Like, it's not like they're not signing the paperwork. They're not taking the risk. They're not committing. When you work with financial planners who aren't intimately invested or financially liable with your account attached to it, they're just giving you advice, and then, like, you're another person to them, or like a number. They're off to the next client. So the fixed fee is fine. I'm fine with that as far as a business model. It's just you have to go and do it yourself now. Like, you aren't really getting advice, or you're not getting counsel. You're getting advice, and you're probably paying $5-10 grand for it. But I would rather that than going to an AUM advisor who doesn't do anything themselves. They're strictly a broker in the relationship, and you really need to know that, because being a broker should not be an ongoing 1%. I think that's very immoral.
So for those people who want to have a better understanding, so we've talked about the statistics. On average, advisors add 2 to 3%, Vanguard has found. So theoretically, a good advisor should add more value than they're worth. They often do. So give an anecdote of any client, whatever, you worked with a client, what's a decision that they communicated they would have made? You advised a different decision that added value in the account, whether that's increasing gains, minimizing losses, just waiting. Give an example of what that looks like, that how an advisor adds value that can increase the lifelong value of the account.
Yeah, I mean, the biggest one is, you would think it's what to buy, but it's actually what to sell and when to sell. So a lot of the selling that happens in our industry is, there's really only like 3 reasons. One, you think it's going to go down, you want to take, you think it's going to go down, it has gone down, and you think it's going to keep going down, or you want to take profits. There really isn't any other reason outside of that I can think of where it's like, let's sell, because if you have a good investment, you want to keep it. But I had a client who, I think he had like $500,000 with us, and we had bought NVIDIA in November of last year, which is right when it started taking off.
Great buy.
And it was actually his rec. He's like, hey, I want to buy some NVIDIA shares. And if it goes up, great. And if it goes down, it goes down. And I'm like, oh, that's a great, like, he's a very conservative investor. So I was like, oh, this is kind of like nice, like a nice aggressive take. And I was like, yeah, I like this. Let's do it. Well, it went up 4%. And he's like, we got to sell it. We got to sell it now. And I'm like, no, Chris, no, let's just wait. And he's like, oh, we got to sell it. And I'm like, okay, what if we sold half of it? It's like, we'll sell half of it. We'll keep the other half. That way you can feel like you took your cherry off the top there, and we can also still wait for the Sunday. Well, then it goes up 30%, and he's like, oh, I should have stayed. So that's an immediate value right there that I provided, but in my head, it was like a no-brainer, right? But for him, that was a massive, I mean, that was the difference of 30 grand for him, right? And I make 5 grand off of him, right? Off of that account. So saved him 30 grand, made him 30 grand technically, and then my fee was 5. You see how that value add is immediately like pays for itself? That's the kind of stuff you're looking for. And if you call an advisor who doesn't pick the investments, they're going to go, let's take a look. And then they're going to say, let me call you back. Let me think about it. Or they're going to, the thing that I see the most is that I see advisors will talk you out of doing anything. So they'll just say, well, just stay. Let's just see what happens. Let's just wait. And the thought process behind that is, one, they don't know what they're doing realistically. And two, within 18 months, even if something bad happened, it'll be back.
Yeah.
So then for 18 months, they got to counsel you to wait. It's a waiting game for them.
Yeah. So the risk adverse skeptic investor that says advisors aren't worth a 1% fee. You can do it yourself, or you could charge a fixed fee. Their answer to that scenario would be, well, that's why you shouldn't be picking stocks, right? Just, you don't need to do all that. You don't need to pick NVIDIA. Just put it in SPY, which for those you don't know, it's a ETF? Is SPY an ETF, or is it
It's just an index.
It's an index fund that basically tracks the S&P 500. So it's basically like putting your money in the market. Buy S&P, buy SPY, and don't think about it. What would you say to that? What value does an advisor add for all of the skeptics out there that says you can't beat the market, advisors can't beat the market, there's nothing better that you can do than pay nobody, put it in the market, and don't look at it for 30 years?
Yeah, first things first with that, they're correct. 95% of money managers do not beat the market, right? And a lot of financial planners will admit that. They're like, we're not stock pickers. We don't want to do that. But they get paid off the stocks. It's like, you're not going to do the one job that you get paid off of. That doesn't make any sense to me. So my actual answer to that, if someone was here, is I would say, well, we're not really picking stocks. We're trying to pick good companies. And that's a little bit of like a cheesy answer, but I mean, you look at people who had Apple from the year 2000 till now, or Microsoft from the 90s, those people are worth $50 million. And they viewed it as like, that's a great company. I want to hold on to it, and that's what I want to buy it. And so we're not day traders in the sense. I'm looking for companies that I can almost essentially partner with, where I'm just going to keep putting money in them.
Yeah.
Because good or bad, they're great companies. And that's really how you have someone who's worked at a job for 30 years and they've kind of just like been given stock over their lifetime, and they're worth $40 million. It's not because they did the S&P 500 and dollar cost averaged into it. The thought process there with the people who say you don't need an advisor is correct if you want to be fine. It's that fine attitude, which is good. If you want to be fine, that's okay. But a majority of people, if you just stuck with something over 20 or 30 years, especially a really good company. I use Microsoft and Apple, but you could use Tesla, you could use NVIDIA, you could use Waste Management, you could use Procter & Gamble. If you just had stuck with these big name brand companies for 30, 40 years, I mean, now your biggest problem is how are you going to pay taxes because you have $55 million.
Yeah.
It's like that's the thought process where I think an advisor really adds, an advisor like us, but just someone who likes the investment side of stuff. I've never met an advisor who really likes it. I've met two. I've met two advisors who really like that, and they're worth every penny.
Yeah.
They're worth every single penny. More. They should be paid more, to be honest.
Is there anything that you think people should know about advisors other than strictly increasing rate of return above and beyond the advisor's fee? Is there another reason to have an advisor? Let's just say they don't outperform the market, they break even on their fee, or they're not even worth their fee. You still get market return, but you're paying 1%. Is there anything else an advisor can provide that's important to this discussion that isn't just beating the independent performance of that investor?
Yeah, I would say income planning. So when you say you have $3 million and you're in retirement, that $3 million, you don't just take 10 grand a month until it goes to zero, right? There is an income strategy that you can create. You can do it yourself if you want it, but an advisor would put you in an income producing portfolio. And then the goal ideally is that you're living off of that. So whenever you go into retirement, an income to make your investment last as long as possible while providing you as much income as possible, that's not a rate of return thing, right? Like, for example, we have clients in retirement. We don't charge them our typical fee that we would because it's not the same work for me.
Yeah. It's
a little bit easier. So it's like, well, if I'm going to be doing easier work and they're going to be getting less return, then they should pay me less. So yeah, I would say that the other real value is like, okay, I'm in retirement. Like, how do I maximize this money? Financial planners and advisors are good at that.
Yeah.
I would say that they're good at principal protection, and then income creation.
Yeah, I like that a lot. I would also add to the retirement conversation is this is where the skeptic's advice becomes very hard to abide by, right? So let me break it down for you. The skeptic who is on the opposite side of this podcast, right? Either they say you should only work with a fixed fee advisor. They shouldn't take a percentage, it shouldn't go up. You have money, or you don't need an advisor. You can do it all yourself. Why? Well, because advisors don't beat the market, right? They can't time and buy and sell. The market always wins. They're playing games and they can't beat the market. Okay, let's say that's all true. Well, what happens when you get to retirement? Well, if you've got a retirement account, you've got to take RMDs. You've got to take retired minimum distribution. The you can't beat the market doesn't exist anymore because guess what? You have to start selling and taking distributions. Are you going to be better than your advisor at knowing what to liquidate and when? Maybe not. You have to take the RMDs throughout at some point during the year. Are you going to be able to be better than your advisor at predicting should I sell in January or February or March? How do I predict economic cycles? Is the advisor going to be perfect at that? No. Any advisor that can promise they can beat the market is full of crap. There's no way to guarantee it. There's no guarantees in investing. But this is where you really have that 1% comparison. Are they 1% better than you? Because when you reach retirement, for 95% of people, you need some of the money. In most cases, you're required to take some of the money because the RMD rules. There's no more conversation of they can't beat the market. You don't need an advisor. You're in a position now where you're retired and you're going to have to liquidate your investments. You're going to have to come up with an income plan. You're going to have to take an RMD. Now there's no discussion anymore of should you buy and sell stocks? Can you beat the market? You have to get out of the market. And now you're in the decision of who's going to be better at making the best guess of how to liquidate my investments over time to sustain my lifestyle. The guy who's been managing my money for 30 years, who's done nothing but study the market at 5 a.m. every day for 35 years, or me who worked construction or engineering my whole life, and now I watched a couple podcasts on investing. Who's going to give you better advice on when to take that RMD distribution? So that really is, apart from everything else we've said, that's where the skeptic's argument to me runs out of room. We can't just stay in the market anymore. We're required to take money out. So who's going to plan that better? Probably the person with a lot more experience in the market. And if they can just time it through guesswork and intuition and work experience, 1% better than I do. They sell NVIDIA at 125 instead of 120 because they're just a little better at reading market indicators. That's a lot of value that you don't lose in your account because they're going to be a little bit better at planning that retirement for you. Is that fair to say?
That's great to say.
All right. Thank you. All right, everybody. That is this episode of 2 Gens, 2 Cents. Thanks for listening. Biggest takeaway here. We're an RIA firm. Any clients that we work with, we work on an AUM percentage fee model. Listen to alternate opinions. Go find a podcast that is all about why you should only ever pay a fixed fee advisor. See what they have to say. Talk to people who think you should only do a financial planner and you should manage all your own money. Talk to people who have managed their own money. People you're close with. Ask them, hey, what's your average rate of return over the last 10 years? I know you're really passionate. You've read a bunch of books about this. You listen to podcasts. What do you get? Do you beat the market? Do you match the market? Are you under the market? I'd love to know how your investment philosophy has panned that, and talk to somebody who has an advisor. See how their account's done. Get a range of experiences. Never listen to only one person, only one angle, ourselves included. Be informed. Make good decisions for your money.
And if you guys have a financial advisor, I know, at least the people I've told to do this, they feel nervous to do it, but go talk to your advisor and be like, hey, why do you think you're worth 1%? Or why do you think I pay you, you're worth what I pay you? And ask them that. And you can even preface it, be like, hey, look, I've been like learning different things about how advisors get paid, and I just want to know if you could describe your value to me.
Yeah.
And if someone can't describe their value to you, then they don't even believe in their value to you. Okay? Yeah, that is the biggest thing, but they're so happy and friendly and nice that you don't think about that. Okay, yeah. So ask, hey, how are you worth what I'm paying you? Are you worth what I'm paying you? I think you'd be extremely surprised.
there's definitely a lot of, well, that's just the way it works type of advisors out there. Well, everyone charges 1%. That's kind of standard to charge 1%. I'm an advisor. I should charge 1%. There's no quantification of why they fee that way. It's just, well, that's the industry. That's how much it costs, you know. So, yeah, great question to ask any advisor. As always, guys, leave questions, comments, reach out to us, future topics, questions you want answered.
Share
to all your friends. This is a particular one. Anyone who doesn't work with an advisor, this is our explanation of why an advisor can likely add value. Again, listen to alternate opinions, but feel free to share this with anyone who's skeptical about working with an advisor. Hopefully this lays out at least an advisor's best reasoning for why they operate the way they do. Maybe we're wrong, but that's what we believe, and that's what we're sharing with you. So any topics, any questions you want to hear answered in future episodes, we'd love to. Video content coming very soon, shorts and YouTube videos, interviews with other people, all sorts of stuff coming very soon in the new year. We're very excited about all that. If we don't have another episode, we're probably 50-50 on whether we'll have one more because Christmas plans. So if we don't see you, have a very Merry Christmas and a Happy New Year's. Thank you to everybody who has subscribed and listened to episodes.
We've grown a lot this year, guys.
We
really we owe it to you guys, so thank you very much. We have a really exciting 2025 coming. A lot of changes, a lot of new things, and hopefully some more fun and educating on the boring stuff.
Absolutely. There's one thing that doesn't change, which is our advice to you. Invest early.
Invest often.
We'll see you next time.